Welcome to Houston Real Estate Radio. I'm your host, Shannon Register, and every week we bring you news and information on real estate transactions. And last weekend we talked about the big CFPB changes coming down the pipe. They start October 3rd. So we're excited to have that going into effect this weekend. We've got a lot of other changes going on, changes in the economy. The economy's always changing. So this segment, we're talking with Dr. Jim Gaines. You've heard from him before. He's from the Texas A&M University's Real Estate Research Center. Always brings us great information. Welcome to the show.
Thank you. Good to be here.
Well, we're excited for you because you just had a big job change. That's exciting. You got a promotion.
Well, as most of our listeners will know, Mark Dotzer was the chief economist here for a number of years, almost 20 years. And Mark decided to go do some other things. And so he left us. And I guess it just sort of fell to me to try to come in and do the best I could to help fill that slot.
Well, we hope he enjoys retirement and hope you enjoy this new adventure. So, but you've been doing this for so long, and in the real estate community, people in the real estate community just love it when you come and talk. I know you come to Women's Council a lot and other groups as well, and HRER and give great presentations. So it's really exciting for us to have you continue to do the work that you do. And, here on the show, we want to help consumers understand what's going on in the market.
Well, don't we all? All are trying to figure that out. It's been interesting. It's been a transition year here this year. As you and I were talking about before we went on the air, that 2015 probably is going to end the year not too badly for the state or for the Houston area. And that's good news because this time last year, everybody was expecting 2015 to be really terrific. It was about this time last year when the oil prices started the significant slide.
Mm-hmm. And then we were just hoping they'd go back up and it wouldn't be but just a blip on the radar.
Exactly. Nobody knew what was going on. Nobody knew how low the prices would go, how long they'd stay there, what the implications would be. Yeah. All of those things. We had people asking us, of course, is this a repeat of the 1980s? Yeah. Is it just a temporary blip? Because and we were reading supposedly well-informed people around the world talking about the energy sector, and I've used this almost as a joke in my speeches, but it was the truth. We read reports that said the price of oil could go anywhere from $20 to $200.
Wow, that's not very helpful.
But no, it's not helpful at all. It's telling you how uncertain and what the volatility and the uncertainty was. Well, it evolves that generally, if you go back to the fundamentals, you figure it out. And the fundamentals are particularly the shale oil production from the United States between what we were doing here in Texas and the Eagle Ford and the Permian up in the Dakotas and Wyoming area. We increased world production to the point where there was more being produced than being used. And all of that was happening. And all that started in 2008, 9, 10. Mm-hmm. It all started also about the time that the high growth users of oil and petroleum products, particularly gasoline, countries like India and China and Russia and Brazil and some of the other emerging countries slowed down or stopped. So the demand didn't grow, the supply did. Well, economics 101.
Yeah, supply, too much supply, demand goes down.
And also, and I go back to the shale production, particularly in Texas and the United States. It's all in the U.S. mostly. An infant industry. It was really just weaning itself in 2010, 11, 12, and even into 13 in terms of efficiency and cost control and productivity and energy. So, for example, in 2010, when the average shale well was being drilled, the average production was about 20 barrels a day when it finally produced. Today, the new wells are producing like 700 to 800 barrels a day.
Yeah, it's a lot.
It's a lot. It also means you don't need as many wells.
So the technology has just come so far so fast that we just don't need what we used to need in wells and time frame to pull it out of the earth and do something with it.
Exactly. Which also means you don't need the people. You don't need the servicing contracts. We've seen a lot of the slowdown to date, and closures and so forth have been the least productive.
It seems like it would have been more gradual, though, than what it was. It came to a screeching halt versus slowing down over time because the technology was getting better and better. It's like it's like the technology just got really good really fast.
Well, it did. I mean, one thing we can do is we can technology. We're innovative and creative. Yeah. And in an industry that's billions of dollars invested, most people in the world don't understand how high tech drilling and exploration really is.
Yeah.
And so that technology boom there, or that learning curve, was extremely steep. Now, here's what it means business-wise and economics-wise. A lot of the companies that jumped into the business were new creations. There was a lot of capital flowing into the energy market. Still is actually looking to get into the market and can't find a place to put the money. A lot of money came in. A lot of these companies got started quickly, highly leveraged, using a lot of debt capital, venture fund capital, and the like. There's going to be a Darwinistic evolutionary process here, and it's starting now. And the reason it's starting now is because a year ago, if you were an oil producer, you bought futures, you sold futures contracts. You were selling your oil for a year or 6 months to a year ahead of time. Some of the oil being actually bought and sold today are based on those contracts. So the prices are still in the $80s and $90 a barrel. Those contracts are giving out starting in October, November, and particularly into December.
Of this year or next year?
This year.
Of this year, okay.
Okay. And that was the hedging. That was the hedging you've read a fair amount about and heard about. That's what has kept some of these companies going and allowed them to continue. And in the meantime, of course, they're trying to reposition themselves. Today, they can't hedge like that.
So you think we're going to see a lot more layoffs, a lot more problems?
We don't think it's finished. We also did some historical analysis here just within the last 30 days in our office. And what we've discovered is there's anywhere from a year to 3 year lag between oil price declines and decline in the upstream energy industry. And by the time it really seriously affects the local economy.
Oh, Lord. So you're not giving me good news.
As we were saying, 2015 has not been anywhere near as good a year as 2014 in the general economy. Our employment is down, as you well know.
Yeah.
In the Houston area, it has begun to hit. We have felt it.
Yeah.
But we probably are going to feel it for sure next year.
So do you think that we're going to see a lot of these, we're already seeing more inventory come on the market. In the last year, we've seen a lot more inventory come on the market, but still not still not 6 months of inventory, still not what we would consider a stable market. Do you think, though, that we're going to have so many houses come on the market that we're going to start seeing the short sales again, like we did, in the past? Do you think that's going to come back?
Yeah. I don't know about the short. The short sales are going to be a function of the financing and actual layoffs. And as people, if people lose their jobs and lose their ability to make their monthly payments,
right?
Then my guess is that yes, we'll see more short sales because now the lending institutions, having just gone through it a few years ago, understand short sales actually are better than foreclosures,
right?
In general,
yeah,
they're actually geared to it. They know how to do it.
Yeah, they figured them out. There's a good process out there for them now.
Exactly. They didn't have processes
right
before. So they have that process in place, or at least they have it in the background. Yeah. So I wouldn't be surprised if we see that. Now, how pervasive that's going to be, I don't know.
Okay.
If it's going to be overwhelming or whether it's just, there'll be some. As you said, the inventory is beginning to pick up a little bit. It's still short. It's still around 4 months inventory.
Mm-hmm.
In fact, I'm looking right now at our statistics for Houston. That's the reason you keep seeing me glance away. We're registering currently in August 3.4 months inventory, which is still very, very, very low.
Mm-hmm.
So we've got some we've got some upswing we can do. But I think we probably are seeing some slackening in the demand side of the equation. We're seeing people.
I think people are getting a little nervous about making a change.
About their jobs, so they're not going to make that commitment by so on. We are seeing, it's interesting. I also get the question, of course, about what we went through last week with the Fed and raising interest rates.
Mm-hmm.
And they didn't raise the interest rates, but everybody just figures it's a matter of when, not if.
Right.
And I was talking to somebody yesterday, in fact, one of the other researchers here in the office, and we were speculating if it would have just the opposite of the effect that you would think. The traditional wisdom is if interest rates go up, it tends to dampen housing demand.
Right.
But in the short run, I have a theory that maybe it actually encourages demand because people will buy, if they're going to buy, they'll buy sooner rather than later, thinking it's going to be more expensive later.
Okay, I can go with that in the very, very short run, right?
So the interest rates right now are not the critical factor. They're
right,
still up.
They vary so little.
A quarter
Most people don't matter. Yeah,
it isn't going to make much difference,
right?
Except for those people right on the cusp.
Now, with the CFPB changes that happened, the Consumer Finance Protection Bureau came out with all these changes for October 3rd. Right. Next week, when we start changing up the lending, the closing statements, and do you think that we're going to start seeing a slowdown here in a couple of weeks from all the CFPB changes?
It's paperwork processing. And I've talked to a number of lenders, and they don't like it because all of a sudden they had to change their processes,
right.
and it'll back up the paperwork a little bit. In terms of the fundamentals of buying and selling and so forth, I don't think it's going to make much difference.
You think it's going to take longer to close a house?
It'll take a few months. It might take a quarter to work out all the kinks.
So it won't slow us down too much.
I don't think so. Okay. I don't think so. The title companies are going to have to work with it, and the lenders are going to have to work with it.
Do you think that, right now, most people feel when they go to buy a house, they think it's going to take 30 days. Do you think that that's going to draw out to 45 to 60 days in the future?
Sure. And quite frankly, even the expectation of 30 days is optimistic.
Yeah.
Even in the last year, that was optimistic.
Yeah, that's true. So, I think a big part of the realtor's job is just to set those expectations and kind of teach the consumer, that it is going to take longer to get it done unless you've got that cash in your pocket.
Yeah, absolutely. And the real estate agents don't. A lot of them understand the process, but they're educators. They've got to teach these because most of these people that are buying, selling houses, they only do it once or twice or three times in their lifetime.
Right.
They don't do it every day.
Yep.
The realtor's doing it every day. Yep. You've got to educate them. You're correct. They've got to set the expectations and explain to them what's going on and what to expect.
Okay, let's go to a quick break, and then when we come back, I want to talk about the market in Texas, how Houston is different than Texas, because we kind of talked about what's going on here in Houston. So we'll come right back after a word from our sponsors, and we'll talk about what's going on in Texas, okay?
Ma'am.
All right, we'll be right back here on Houston Real Estate Radio.